13 apps came out not long ago, and I always try to analyze them to find potential buying opportunities in the stock market. I haven't found anything as of late, but the last one, which was very successful, one that I found was in 2022. I shared it on YouTube. It was TPL, Texas Pacific Land. I've never heard of it, and I saw a fund buying into it. I researched it, bought it, made 40% in I think 3 months in early 2022. And since then, I haven't had much luck in terms of 13 apps. But in this video, I have Michael Burry. I'm going to discuss 2 stocks that he bought. And I think both of these stocks are trading at fair value. One of them is more on the undervalued side. And they are still better than nothing in this overvalued market where it's very hard to find value or very hard to find amazing companies trading at a fair value or fair price or a little bit on the undervalued side. So I really believe you guys are going to enjoy this video. Now, I have to say Michael Burry is the hardest person to clone. So if you're more of a cloner, you tend to clone Warren Buffett or someone like that, don't try to do that with Michael Burry. He could already be out of these investments. This is why I do these videos, so we can have our own thesis, not just go follow him blindly and then lose 20 or 30% when he could have been sold. All right. Now, the first stocks that he bought, which is very interesting to me, and I think is trading at fair value, this is a company called MGM Resource International. The stock has been on a recent run lately, since September. It has gone down a little bit before on earnings. Now it's trading around $42 per share, the same price it was trading at in around 2023. So MGM Resource, most of you know the company. They own many casinos, resorts, properties all around the world, over 18 of them in the United States. They own some in Europe, they own some in Macau, they own some in Japan, and pretty much all over the place. Very popular place, and most of you know this company. They own many different brands. Also, in terms of the Las Vegas operation, we had the Formula One here in Las Vegas this year, and they posted pretty good numbers as of late. The revenues was up around 5%, EBITDA was up 2%, margin declined a little bit from higher inflationary costs. A lot of it is due to staffing and a tight labor market and stuff, but they did decline in terms of margins, but everything else has been improving. In terms of MGM China, and this is what you have to focus on because they're still somewhat recovering to pre-pandemic level, and they did recover to pre-pandemic level. I'm going to talk about it in a little bit, but the MGM China numbers are extremely impressive. Over 9% revenue growth, 18% EBITDA growth, and margin expansion of 220 basis points. And this is what has driven a lot of the growth lately, and I think it's going to continue in terms of China. If you look at the latest numbers, over 1.3 million visitors entered Macau during the 8-day Lunar New Year, which is, I think, the Chinese New Year, which ran between February 10th and 17th. So around 7 days, over 1.3 million visitors. And they said that they pretty much almost 99% comparable to pre-pandemic of 2019. So they're now finally recovering to their 2019 kind of levels. And this is the opportunity you have with MGM. MGM has over a 15% market share right now in China. And I think it's eventually going to grow in the future. They have pretty amazing property over there and a pretty good reputation, I think. Now, in terms of the Super Bowl, we know what happened. A lot of people were betting on the Super Bowl. I think it reached pretty close to $23 billion. And as you know, MGM has a piece of it. They have something called MGM Bet, and they have another one, I forgot what it was called. But MGM Bet still has a pretty decent market share, around 23-24% in the United States. It's losing market share to other competitors, most likely DraftKings and the other one. But I bet MGM still has, pretty good market share, and at least it's a part of something bigger, because these other companies like DraftKings, they don't really have live casinos and all these profitable stuff that MGM has. And this is why if I had to bet on something with sports, I would bet on a platform that they have physical casinos, they have this free cash flow machine, and they also have the sports betting business, kind of like MGM had, which I like very, very much in terms of the balance sheet. Normally, whenever you see a lot of the casino operators, hotel companies and stuff, they tend to have a lot of that. This is not the case with MGM. They have pretty close to $3 billion in cash and cash equivalent. Long-term debt is $6.3 billion. So this is pretty close to a $3 billion in terms of net debt, which I don't believe is too high for a company like MGM, especially for the kind of free cash flow that they're putting up. And they're also buying back a lot of stock lately, which is something that I like, especially after what happened after 2020. The stock has suffered for some time. MGM has recently recovered, but it's still much lower than what it used to be in terms of a valuation metric, which MGM right now is trading at only 10 times free cash flow, or pretty close to a 10% free cash flow yield. Now, this is a company that's still improving, it's still recovering in Macau, amazing property and high growth over there. You have BetMGM, which, yes, is losing market share, but it's still somewhat growing. This is a rapidly growing market. And you have the US operations, and they have pretty good monopoly in these kind of markets. So for me personally, looking at MGM at 10 times free cash flow, and with the good balance sheet that they have, I don't think this is too expensive for this company. You should trade at 15 times average market cap to free cash flow. And I was only trading at 10 times free cash flow, or a 10% free cash flow yield, for a company that's expected to keep increasing the free cash flow in the future. Over 1.3 billion for 2024 and pretty close to 1.5 billion in 2025. So over the next few years, we know that this free cash flow is sustainable, and MGM is likely going to use it to keep buying back, stock, buying back a large percentage of the market cap, like they've been doing. It's been pretty close to 15% of the market cap, 13% of the market cap lately, and I would expect this to continue. Maybe they could buy back another 10% in 2024 using the free cash flow, or if they want to pay down some debt. But they do have pretty good free cash flow profile, and for the company, I think this is why Michael Burry bought it. I think this is a stock that's not extremely undervalued, it's not overvalued, it's not a bargain, but it's more of a good company trading at a fair value, or a little bit on the undervalued side. And relative to other opportunities in the market, I think MGM resorts make sense, and I prefer MGM over Wynn Resorts. I mean, I checked out Wynn many times, and I just cannot understand why this company is so much more expensive than MGM. Maybe because they own their own real estate, and MGM has some lease back kind of thing with VC properties and many others. But again, I mean, MGM is a good company. I think it's a pretty good company trading at a fair price. Now, the second stock is a little bit more on the undervalued side for value investors. And this is a stock I talked about many times, and most of you are familiar with it. And this is a stock called WBD, which is Warner Brothers Discovery. Over 4.5% of his portfolio. WBD has been an absolute disaster. It keeps going up, and then people celebrate, and then it makes new lows. And it's been frustrating for shareholders. I used to be a shareholder myself. I sold around $13.50 like in 2022, and I bought Google back then, and I suffered a 27% loss buying it when it was Discovery, even before the merger. And then the merger happened, and then they had the pro forma numbers that didn't play out. And you guys, most of you know my story with this company. It's my biggest loss over the last 4 or 5 years, pretty much. So Warner Brothers Discovery, we're not good friends with this company, and it just keeps making new lows, $9.83. And it's been crazy, even though the business itself is starting to improve. But I believe the market was expecting a little bit more growth in revenue. And for me personally, I don't think this is what investors should be focused on. Revenue growth is important, of course, but I think WBD can return a pretty decent return without them having to go, even if revenues is flat or slightly declining or slightly increasing. I still believe WBD can return fantastic kind of upside potential over the next few years. And this is mainly because they are not focusing on just growing at any price. They are focusing on profitable growth within the streaming space and within the movie space, within the theatrical, and everything that they're trying to do. As you could see, revenues was pretty much flat, up 1%. Adjusted EBITDA is up 22%. Free cash flow was negative 200 million, which was not accurate. They had a lot of one-time expenses when they merged, but now it's 2.1 billion for Q3 of 2023. DTC profitability, this is what they're focused on. If you look at the total DTC subscribers, they went down around 700 million. So they decreased in subscribers while something like Netflix is increasing. And this is bad, but the same thing is happening to Disney, and the same thing is happening to Warner Brothers Discovery. I think they are not focused on gaining as many subscribers are possible, but they are more focused on profitable growth, even if it's slow, even if they have to churn and lose a little bit of subscribers for a while until they get on the right sustainable path of adding the right subscribers at the right price and focus on profitable growth, which I think is more important than just growth at any price. And ARPU is still up around 6%. Adjusted EBITDA was a loss of 600 million, and now it's positive net of 100 million. And this is a massive, massive improvement. It led to some losses in subscribers, of course, but this is just the cost for WBD to be profitable. They had to increase prices. and do many different things. EBITDA trend has been massively improving from a loss of 734 million to a net gain of 545 million. I mean, as you could see, it's not much about revenue growth. It's more about profitability and using the free cash flow to pay down as fast as possible, as much debt as possible, as quick as possible. This is the whole thesis, because the company has a lot of interest expense, and interest expense for this company is pretty close to $574 million a quarter, which is around $2.1 to $2.2 billion every single year in just interest expense. So this is why I believe WBD does not need to grow revenue for you to get paid as a shareholder. The massive value creations for shareholders is going to come from debt pay down. And the company still has around 45 billion of gross debt. So that has been coming down. It went from 51 billion to 43 billion, and they are focused on deleveraging and paying down the debt as fast as possible. And I think the company can continue to do that with the free cash flow expected 5.3 billion in 2023 and over a 60% conversion rate over the long term. I'm not sure what this could lead to. I'm not gonna try to guess, but 5.3 billion of free cash flow every single year is more than enough to pay the near-term maturities, which is around $9 billion, 19%, $9 billion is due over the next 3 years, but over $5 billion of yearly free cash flow is more than enough for Warner Bros. Discovery to quickly deleverage and pay down the debt, which most of it is fixed at 4.6% interest rate. So I really like what I'm seeing over here. And if you do use the free cash flow number of 5.3 billion, the market cap right now, it's only $24 billion. So this company is trading pretty close to 5 times free cash flow, which is dirt cheap. But we cannot really use market cap to free cash flow because they have so much debt. If you put it on an enterprise value to free cash flow, it's around 13 times enterprise value to free cash flow, which is not cheap, but it's not expensive either, in my opinion, for a company with the kind of moats that they have, with the kind of content and libraries that they have, with the kind of value creations they can create if they decide to sell some assets. They did sell a little bit of assets, but they could do even more in the future. And they do have a partnership around sports, I think with Disney and some other company, I forgot what it was, and it's pretty promising stuff. So around 13 times free cash flow, 5.3 billion. If they pay down the debt, the free cash flow could be up to 7.5 billion. And I think it's ultimately going to get there, even though they don't really deleverage as quick as possible. But the main return that shareholders should be looking for is the 5.3 billion of free cash flow, which is likely going to keep growing into the future. And if they can keep growing it into the future, they can potentially create even more value for shareholders. They have a 60% conversion rate over the long term. Now, if they do sustain around 11 billion over the next few years, this is pretty close to a $7 billion free cash flow number without them having to, without factoring in interest expense coming down, which increases free cash flow. So I really like what I'm seeing over here. It's very hard to calculate the exact return for Warner Bros. Discovery or intrinsic value numbers or whatever, because it's hard to know how much debts they're going to pay down, what kind of things they're going to do with the free cash flow. But again, what the company is doing, what the CEO is doing, seems to be working in profitability, not much on direct-to-consumer user growth, and not much on revenue growth. And I think the market is focused on the wrong thing. And eventually, when debt starts coming down, interest expense starts coming down, free cash flow increases. And once debt starts coming down, then they can return value to shareholders through buybacks and do dividends. Now, if the company could buy back stock, I'm sure the stock would not be sitting at $9, but they can't really do much because of the 9.3 billion that's due over the next 3 years. So a lot of this could change if you're a long-term investor, and I think this is why Michael Burry bought WBD, and this is why he bought MGM. MGM is a little bit safer. WBD has higher risk, but also higher reward. And it was not financial advice. It was just my opinion on these two companies. I really hope you enjoyed the video. So if you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.